So what can we expect in 2025 in the flip market? So 2024 was, kind of a hit and miss year. What's going to happen in 2025 is really going to be determined by interest rates, and not the interest rates you're thinking about, not the private money, not the hard money. We're going to concentrate on what's going to happen with the consumer, the people who are buying. We want a bigger pool. We want more people trying to buy properties, looking at properties, and more important, be able to afford properties. That's the number one rule when we're looking at selling any kind of product, including homes, is affordability. Not only what someone can afford, but what they can qualify for. And I want to go through some simple examples to show you why interest rates for the consumer, the conventional rates, FHA rates, whatever it may be, are more important to you as a flipper than the hard money, private money, whatever rates they are. So let's start with number one, why hard money loans are not going to impact you that much. Hard money, private money is really affected by what the Fed does because there's a couple different markets out there that determine rates. And when you're looking at private money, short-term money, bridge loans, hard money, whatever you want to call it, it's basically the same box. And that's really dependent on what the Fed does with the Fed funds rate. As they lower, typically you're going to see all these rates go down, but it's not going to impact you that much. Because let's look at an example. Let's say you have a $300,000 loan out, fix and flip loan. You're going to carry it for 6 months. And let's say interest rates go down 1%. So every time it goes down 1%, what is that going to impact you? 1% of 300,000 is $3,000, but you're only keeping it for 6 months. So a 1% drop is really only going to put a possible $1,500 into your pocket. What we want to see the other interest rates out there so we can have a bigger pool, more people looking to buy properties, more competition, more people looking and wanting to buy, helping prices go up. But how does that happen? So how do conventional interest rates impact you as a flipper? It's one of the biggest items you have to look for and watch out there because the lower the rate means the bigger a pool of buyers, people who are looking to buy. You want as many people competing for your property as possible, and that all comes down to affordability. Remember, when you're a consumer, when you're on the other side of this, it's all not only that fits inside your budget, what can I afford every month, because there's only so much everyone can afford, but it's also what do I qualify for? Because even if I feel I can afford more, the banks and mortgage companies will say, well, here's all you qualify for because of your debt ratio. So here's where interest rates are going to impact you next year. And we're hoping that, like according to NAR, National Association of Realtors, has a great projection where interest rates will be between 5.5 and 6.5. That would be great. Others see between 6.5 and 7.5. So hopefully the government can get us into a position where people want to invest in the US, put more money in. The more money that comes in drives those rates down. It's kind of more of an open market when you're talking about conventional rates compared to what the Fed does with the Fed fund. Here's where it looks at. Let's say someone has a budget. They qualify for $2,800 a month. So that's what they qualify for. That's what could also fit in their budget. Here's where interest rates impact us as investors. So at 7.5%, they can afford, based on $2,800, a $400,000 purchase. Now, if rates go down to 6.5, they now, with the same budget, the $2,800, can now qualify for $440K. So we have just seen an increase in the people's ability to actually purchase properties that are a little bit higher on the price point. So if you have a house that's out there sitting at $450 or $440, you want interest rates to go down because that means there's more people. There's more people who qualify for that purchase, that price, and you don't have to drop yours. But let's just say NAR is right. It goes down to 5.5. And, I believe in 2025, it's going to be up and down. There's going to be some great months. There's going to be some months where it goes back up. You got to be ready. You got to be having your buyers ready too, but having the properties ready for when rates go down. So at 5.5%, people at $2,800 can afford a house of $490,000. So that's where interest rates impact us. We want to see rates go down so people could afford more based on a budget and what they qualify for. 7.5 to 5.5, we see a $90,000 difference that allows our markets to expand to, get people into those higher price points. So let's look at it this way also, in the sense that if someone has a $2,800 budget, we understand with interest rates going down, they're going to be able to afford more. So let's look at it from the other perspective now, just because one thing may, resonate with you and the other one, might make it a little bit clearer why we want to see interest rates go down, where interest rates will go, and that'll increase the pool of buyers. More people buying means there's more chance to get a better price for your property. So let's look at numbers. $400,000 purchase. $2,800 budget. 7.5% interest to qualify for someone, a family or whatever, to qualify. They're going to have $8,000 a month in income, just based on 35% going towards their house. This just is more about understanding how it impacts it. There might be $1 or $2 here or there. That means yearly, they're going to need $96,000. Now let's look at the same family now when their interest rates go down to 6.5. So at 6.5%, the monthly required income goes down, and so does the required yearly amount. So more people will qualify as interest rates go down because of the income qualifications when they're looking for the mortgage. Now let's look at 5.5. If we get down to 5.5%, this goes down to just under $6,500 a month, or around $78K in qualifying income for a couple. So between 96 and 78, every time the interest rates go down, the pool expands, meaning there's more people, there's more families who could qualify for a $400,000 purchase. Because at 5.5, all the couple has to make is $78,000, or about $39,000 each, which is doable in most markets. Compared up here, where you're at 48,000, you have to qualify. This pool is smaller than this pool. There are more people who, as the rates go down and the qualification requirements for income go down, means our pool expands. That means there's more people here looking to buy a $400,000 house than when interest rates are up. So 2025, what we're concentrating on is what's going to happen with interest rates. Interest rates for conventional loans, even for DSCR, are more based on the market themselves. What's happening in the market? How many people, how many institutions are buying the 10-year treasury? That's what they price 30-year mortgages on. They look at the 10-year treasury. If that's going up, which if the rates are going up on the 10-year treasury, all that means is the government has to give an incentive for people to buy them. They have to raise the interest rate that they're paying so more people will invest. What we're looking for is people, the countries, the institutions, all the retirement funds to buy more debt, to buy more 30-year mortgages. So there's more people buying than selling. That means rates will go down instead of up. And that's what we're hoping for. The world feels that the U.S. is in a good spot with inflation, with their debt. All of those kind of things at least have a handle on it, which has a better chance for us to hit, in the 5s than in the 7s. We want everything to point towards a bigger pool. More people qualifying, buying properties, so we could sell more, and not only sell more, but sell them for a better price, make more money, and enjoy 2025. So I'm going to be optimistic. I'm looking at rates, and we've seen them in the last 2 or 3 weeks start inching down again. The DSCRs, even the 30-year, where they've gone down at least a half a point. I do believe, and we even see it right now with the rate lenders, we're going to see rates in the 5s, maybe not the middle 5s, but maybe at least in the high 5s, which is better for us as investors out there looking. Cost of money is part of what we need to watch and look for as investors, because the lower the cost of money, the bigger the pool, the more people looking to buy, meaning we have more options to not only sell a property because there's more people looking, but even sell it for more than we were asking for. On the next video, I really want to go through another secret, another thing that I see out there. Instead of dropping prices on homes, buy downs, how a 1% buy down is better than, like a 10% drop in your price. So catch me on the next video, like this, share this, and we'll see you next year.